Bill Faeth joins me here today. You can head over to billfaeth.com and that you spell faith Faeth. I'm going to have that as a clickable link in the show notes, but really appreciate your time, Bill. We're going to be talking primarily short-term rental, but man, it sounds like you got experience in all walks of life here.
I'm excited. Thanks for having me. Let's dive in, and I'm happy to talk about anything.
Let's start with the short-term rentals because that's a hot topic typically. Like, what caused you to find your way into that, especially with all of the other investing activity you have going on?
I was a long-term rental guy. I mean, I've been in multifamily, commercial, long-term rents since I was 19. I'm 51, so I've been doing it quite a while. I live in Nashville, been here, been a born-again redneck for 23 years now. Playing golf with one of my buddies who's an electrician. He owned a condo in the same building I did in downtown Nashville, and he had switched to short-term rentals. So I'll make it a super short, sweet. I mean, I'm charging $2,800 a month. He went out and did $7,900 in his first month in 2015. I called BS on it. A week later, we played golf on a Saturday. He brought a P&L. He showed it to me. He showed me this thing called Airbnb, which I'd never heard of before. Just a little quick research. I found out Nashville at that time was the number one short-term rental market in the world. And there was about a 4 or 5 year run. But I was also in the ground, I just come out of the ground transportation space. I built the fastest growing limousine and motor coach company in the history of the industry. And I was battling Uber and Lyft in city council meetings as they were taking over our industry. And I got very familiar because I saw all these B&B bills that were coming down the road. So that's how I got in, but I did not invest into Nashville. I've actually never invested into short-term rentals in Nashville because of the political volatility with the regulation. And I just went down to Gulf Shores and started it with a beach property in 2015.
Hmm. So, what I think is one of the interesting lines here, Bill, is that it looks like you've scaled like 31 plus different businesses over your career. I'd be curious, based on the experiences there, what did you bring to your short-term rental business?
I think the number one thing for me is that I treat it like a business. And I mean, everything from the financials and the back end to all of the different components. And I started doing that from day number one, even though I made the fundamental mistake,
Yep, absolutely.
kind of bring the business side to it based on that experience that you mentioned. But I did make one fundamental mistake when I first started. Like a lot of people that get into it, I went down to Gulf Shores. I bought my first property, and literally, I ended up using a property management company that a realtor that I used was associated with. That lasted all of about 90 days when I started questioning about marketing plans and lack of visibility into what they were charging and their invoicing. I took it over as a self-managed property with my wife. So basically, every business, probably at least in the last 15 years, I apply the exact same concepts. And really, what I've found in my journey in short-term rentals is one, I still believe today it's the number one asset class in real estate to invest into. But, for me to be able to go and triple or even at the time 5 or 7x rental income, that's a viable business. So I started to scale super quickly, but I didn't have a lot of money then. So what I had to do is figure out how I was going to max out every dollar out of that property so I could replenish the down payment that I made on property number one to get to property number two. So a lot of that came through like just any business. If you want to be successful, you got to be good at two things, in my opinion. It's never the best product that wins, it's the best sales and it's the best marketing. And that's what I've learned in my adult life. So I applied that to my short-term rentals. Literally in 2015, I start running Facebook ads. I'm using social media. I'm building an email list, all of these things that now people are starting to implement post-COVID since the run's been done, right? And starting to look at it as a real business. But for me, it's always about cash flow reports, balance sheets, P&Ls, as opposed to treating it kind of like, oh, that's my beach house. And if I can just make a few dollars to make the payment, you can't scale that. Early on, that my wife and I discovered, we thought we were beach people. So we thought we were buying a lifestyle asset, but we found out we're really mountain people. So what happened is I had to really make sure that I was leveraging and squeezing every ounce of juice, meaning financially, out of that turnip to where we could get to the mountains. And then we went to Banner Elk, North Carolina. And then we're like, well, shit, we love this, Jack. So then it's like, we need to go to Montana, and then we need a lake property. So what we did is we re-architected our entire life and rewrote our life plan. And we started investing, not strictly based on financially driven decisions, but where we wanted to spend our retirement. And I think fundamentally, A lot of people will probably never navigate in and go all in, to build a $30 million portfolio like I've done in short-term rentals, but they may want that one house for retirement or that beach house and a mountain house, right? They do one fundamental mental mistake. They wait too long. We started in our early 40s. We have leveraged real estate to achieve our financial freedom. Most importantly, we've gone in and really followed a model I learned from Reg Booth, my business partner in my Glow Golf business, is to build and develop and buy in clusters. So Whitefish, Montana, our favorite location. I currently own 3. I just sold a big $3.4 million property last Friday. Gulf Shores, I've got multiple properties. Smith Lake in Alabama, I've got multiples. Banner Elk, I've got multiples. Scottsdale, I've got multiples. We go in and buy our lifestyle asset first. Still has to meet the fundamentals, right? Still has to have cash flow, solid appreciation, good tax benefits, and then we focus on number 4, which is our debt pay down. We always try to accelerate that. Those are my 4 principles, but then we'll go in and make the financially driven decisions to support that asset.
So a couple things to unpack there. Well, first off, I think it's important that you called out the fact that you treated this like a business. Unfortunately, you probably see this more often than I, since you teach people how to do this. It seems like a lot of people get into this as a side hustle or a hobby, and they don't actually treat it like the business it deserves.
I would agree with you 100%. You have to know the financials on the front end, the middle, and the back, right? But really the front end. I think the people that get into it as a hobby or as a side hustle, they don't go in depth enough, and then they go just buy an average deal in a market that everybody else on social media is telling them is good. The Smokies, Branson, Panama City Beach, whatever it is. They don't know how to underwrite. They don't have the tools, the performas, the calculators. They don't have the experience and the research and understanding the data set tools and, really diving deeper into the market. Those are the things where I see the person buying the average 3-bedroom, 2-bath, they make a mistake, and then they end up being cash flow negative, and they're not getting the appreciation as well. I do treat it like a business because one of the things that's super important to me is that I will never forget all the principles that I have that I employ today, that I literally teach my 33,000 students, is the mistake that I made with property number 2. And property number 2 literally almost set me back probably a good, 2 years when my wife and I were on my journey. And that was not something that we could afford to do at that time. And so when you get set back 2 years and you make mistakes, hopefully we're smart enough. It's what Dean Graziosi, a friend of mine, calls success tax, right? If we can learn from that and apply that moving forward, and those are things that we've had to do. That mistake I made in property number 2 is what set the formula for me moving forward. To one, I will not buy a property if it underwrites over a certain level of debt service coverage ratio. I don't just rely on Airbnb or Burbo or STR Insights or AirDNA. I'm running multiple sets of proformas to make sure that I'm mitigating risk. So for me, that's about a 7 to 10 hour process just on the financial analysis side and the research side. Once I've honed in and selected a property that I do want to make an offer on, they listen to the real estate agent. Oh, I'm buying the house from Jack. He did $75,000 a year in revenue. I'll just budget the $75,000. What they don't know is that Jack was overperforming the market by 25% and has skills that they don't have when they're purchasing that property.
Another thing you mentioned was buying these properties in clusters. This is something that I've had a hard time making some of the numbers work, because with turnover and everything associated with single family homes and short-term rentals, just turning it costs so much. And sometimes these numbers aren't working. But I imagine scaling and clustering them together, that actually supports your scaling model when it comes to short-term rentals.
You get scales of economy by doing that, right? But what you can do is you can get distribution of cash flow. So I'll just give you an example. I use Whitefish, Montana, because that's kind of the market that people tie me to, because I've made some recent investments there. I started in Gulf Shores. I moved to Whitefish. I bought a house like the cabin you would imagine in Montana that everybody wants. It's on the river, amazing views, fly fishing, but it's just an average 3-bedroom, 2-bath cabin. I paid $980,000 for. All the underwriting, all the data set tools showed me that it would do between $90,000 to $95,000 in revenue, which means that would probably be about $35,000 to $40,000 in net income. That is not a solid investment for $1 million investment, in my opinion. I knew that I could do more than that, significantly more. I thought I could do 50 to 60% more. I did 103% more in year number one. So that's $1 million single family home. The very next purchase, I bought $1 million 2-bedroom condo, but it's literally at the entrance to Glacier National Park with 7 million people or however many they're going in and out of that park. And it was so nice, new construction, nothing within 30 minutes existed that was that nice outside of this place called the Fortress that the couple built, like 8 condos there. Then I go and I buy a $2.95 million, 5.5 acres, mega super property with 2 houses, a river, a pond that I stocked with trout, and I could sleep 28 people there, right? And I hosted like a B&B camp there as well. And then the next purchase was a $570,000 1-bedroom condo, ski in, ski out at the ski resort. So it's very well diversified, right? It's not like I'm buying the same type of properties or going and buying 3 or 4 townhomes side by side by side. I have diversification of property type, revenue structure, and most importantly, seasonality as well. And kind of what I took is I started at the beach. I went to the mountains of North Carolina. I came back down into Alabama to a lake, went to Scottsdale, went to Montana because I wanted diversification. 1, of land value for tax benefits when we're doing cost segregation studies. 2, for seasonal cash flow diversification as I'm scaling my portfolio. And all of those markets appreciate at different levels. So as I started to build wealth, right, Montana has been my most recent play because of the fact, and it's for most people, it's not a great cash flowing market, but whitefish specifically, and in a specific property type and price point, the appreciation is off the charts. And I just proved this in a property that, one, I couldn't get a short-term rental permit on. I turned a $600,000 appreciation in 7 months because I bought in the right price point. So I did get out unscathed, thank goodness. A lot of people buy markets, Jack. I buy individual properties. I would never invest into a market because that's not what's going to give me the return.
So, I mentioned that a lot of people struggle. You also mentioned that people get into this too late. Can you elaborate on that? And like, I'm guessing at this point, I'm in my 50s. I probably better not be looking at short-term rentals at this point then.
And I don't mean too late for short-term rentals. A lot of people think short-term rentals are dead. It's like the furthest from the truth. They're amazing still. I am not investing into anything long-term. I did just close on a hotel in New Orleans, but that's essentially short-term rental under the guise of a hotel permit, right? So I am still very bullish on short-term rentals versus long-term multifamily. Now, I love the boutique hotel component because then I can get a multifamily valuation leveraging short-term rental cash flow versus long-term rental cash flow. What I mean by too late is the people that wait till they're too close to retirement to make the investment into their retirement home. Whether it's just going to be a primary residence or a second home, whatever that is. I started when I was 41, and by the time that I'm 60 in my life plan, when I wanted to retire, at that point, that gives me 19 years to pay down that debt and to let my renters come in and be the ones to make the payments on that to where I don't have to. Then it's a much bigger risk for me. So what I'm saying is I think the average human being, whether they're a teacher like my mother was, whether they're a wealthy entrepreneur, a doctor, whatever, they just wait too long to think about retirement and that planning of what that next step's going to be from either a primary residence or a secondary home that they would want to utilize.
Well, you said you started in your 40s. Like, when would you suggest somebody tackle this? Like,
Do you know who Avery Carl is?
Yeah.
Avery Carl from the Short Term Shop. She was on my podcast this morning, and we were talking about she just bought a property in 30A, and she lives down there as well. The reason she bought the property was for her 6-year-old son. It's not too close to her house, so it's a little bit away. She got a smoking deal. It started at $1.18 million. I think she got it for $815,000. It'll cash flow. It's not going to make a tremendous amount of cash flow in 30A, but she's buying probably at the lowest available price that thing will ever see. I think it was built for like 890, right? 30A is going to appreciate massively over the next 20 years until he takes that property after college. And I asked her, I said, what do you think that thing will be worth? She's like, I don't know. I said, well, nobody does, but that's going to probably be worth 2 million, 2.2. It's not going to be 900,000 in 20 years. So she bought it as the investment for him, right? 20 years down the road. There's an old adage, regardless of what type of real estate is, the best time to buy is now. There's no reason to wait. Jack, there's so many people right now sitting on the sidelines. They're waiting, for if President Trump's plan works and he drives the treasury note down and interest rates come down, he refis our debt and then mortgage rates come down. They're going to wait till 6% or 6.2%. We will see millions of people. We'll see pricing go up. We're going to see multiple offers on high value properties, just like the one I just sold. This is the worst we've ever seen in my lifetime for a number of properties being sold. It's worse than the Great Recession in 2008, 9, and 10. And I just sold a property at $200,000 over ask. The high demand properties are still going to be high demand. So I'm a big believer that today is the day that you need to invest into real estate. It is less volatile than the stock market right now. It's going to appreciate. It's the only thing. The short-term rentals is the number one tax benefit that we can get, whether we're a W-2 or an entrepreneur, right? You just got to do your research and learn how to underwrite before you go make that purchase.
Just to remind everybody, billfaeth.com, billfaeth.com, spell faith with an Faeth. That's going to be a clickable link in the show notes. If you found some value in what we're talking about so far, do us a quick favor, share this with one of your investor friends. And if you're watching us on YouTube, give us a quick like and subscribe. So, Bill, based on everything you've seen, and you've talked about the market, I can't agree with you more. Now is the time to be buying. If there's any kind of market correction or property, there's some deals to be had. It seems like it eludes people that when interest rates may eventually drop, there's this thing called refinancing that can be done later too. Like lock up the property at a good price.
I would rather pay a higher interest rate at a lower price and then be able to come in and refinance later. So I don't have a problem.
You're back.
There we go. I don't have a problem paying 7.5% today, Jack. And like this hotel we just bought in New Orleans, we paid 7.5%. I firmly believe within 24 months, I will be able to refi that rate down. No question. And it'll probably cost me $5,000 to $7,000 to refi that rate down. I'm writing an offer for a $2.7 million property, albeit 7.25 on this single family home. And I'm fine with that because the pro forma works. The cash flow's there in its current state. I'm putting 20% down. The appreciation is going to be about 5.5% to 6% on $2.7 million. That's a lot of money on an annual basis. And so what I do in regards to that, just to let your listeners know, I take 24, 23, 22. I eliminate 21 and 20 because we'll probably never see that again in our lifetime. And then I go back to 19 and 18 so I can get a 5-year run rate on appreciation. All you have to do is ask your agent to pull the NAR appreciation records and they can get that to you. So that checks the appreciation box. Then the other thing I do is I try to always accelerate my debt pay down. So I will never do like interest only 40-year, 30-year notes, that type of stuff. I'll try to do 20-year commercial loans, sometimes some 25 years. If you're tight on cash, just do a 30, but make sure the bank you're using will let you make additional payments to where you can accelerate that. So I'm kind of structuring and looking at all of those things. And one thing, because I'm a buy and sell guy, I'm not a buy and hold long-term guy, because I want to keep leveling up and using equity as opposed to going to the bank account or the Roth and, pulling cash out. So I've really got to estimate how long I'm going to hold this property, especially if I'm going to do a cost segregation study on it, or if I'm using 1031 funds. And I think a lot of people don't think about the ramifications of not identifying that and using that information as you're underwriting the property. Because my gosh, if you go and you do a 1031 and then you cost seg and you're on a DSCR with a 3-year prepayment penalty and you got to exit ahead of time, you're going to have a tremendous amount of recapture and tax liability. Too many people are using 1031s just to kick that can down the road, not understanding what the true ramifications are if they ever have a life-changing event to access that capital.
So, let's go into the short-term rental game here a little bit. Are you seeing over the course of time here now any kind of trends or anything we should be aware of? It sounds like you're kind of focused on scenic areas, frankly, but what other things are you seeing? Like maybe even accommodations that people might be missing?
Yeah, I think one of the best real estate guys in our industry is Pace Morby. And Pace is a very dear friend of mine. And we were talking about a couple of months ago, he had colossal failure in short-term rentals. Doesn't make Pace a bad investor by any means, but he just went into like Atlanta, suburban market, and he sent his people to IKEA and bought stuff on Amazon and just did the regular stuff during COVID, made some money. But then post-COVID, you can't compete because people went back to normalization, right? So I am in vacation rental markets that has regulation. I don't invest into markets that is unregulated because I think regulation is the riskiest component of our industry. Hotel lobbyists have a lot of money. Airbnb doesn't do much, and Vrbo and HomeAway and Expedia to lobby against them. So I stay out of the urban areas. That's why I'm not in Nashville or Philadelphia or Dallas or anything like that. I go after a buyer persona. And for those of you that don't know what a buyer persona is, it's a fictional representation of your ideal buyer, which you should know in any business, called Wealthy Wendy. And it doesn't matter if it's that one bedroom condo for 500 grand or if it's sleeps 28 in the $3.4 million property. I'm going after the same buyer because if we do have a 20% correction in our economy and that blue collar Bill, I'll call myself blue collar Bill, and I'm making 200 grand a year and I lose 20%, that's $40,000. 40,000 out of a $200,000 a year salary is a huge hit. But if Wealthy Wendy's family and Wealthy Walter are doing seven figures, making $1 million a year, and they lose, I'm invested next to, ski resorts and, national parks, which everybody will always continue to go back to national parks because that's the built-in insulation. But there's one key differentiator on how I invest, Jack, and it's what I call building super properties. It's not the biggest and most badass properties with all the amenities. There is no question that is part of my brand, and I do have those things. But it's really about buying properties that are unique without having to add those features because anybody can do interior design and add hot tubs and that type of stuff. It's about buying what God built, the location, the views, the proximity, the access to rivers and bodies of water and national parks and ski resorts. You can't replace that stuff. So that's what gives me what I call the insulation, the moat around my properties. And then I can add on the other stuff to get even a bigger competitive advantage. But that's why I invest where I invest. I think there's two things that could be detrimental to our industry. Number one is going to be regulation, and number two is lack of consistency. So I am very, very consistent from all of my properties. So if you come and stay with me at one property and then go someplace else across the country, you're going to see very similar amenities, very similar communication. The designs will be different, but the holistic approach is exactly the same. And it's to absolutely over deliver on the expectations of our guests. We roll our towels, we stage, we design to where it looks like you're walking into a 5-star luxury hotel. We have robes, we have slippers, we have bath bombs, we have standalone bathtubs. The thought process when we designed, Jack, like we in that Montana cabin, which is just an average 3-2 cabin, we redid the entire master suite. And I remember when I showed up and my wife's my designer, and I look at the shower and I'm like, what's that little niche down there? So you got the niche where you put your shampoos and all that stuff. She's all, that's for women to shave their legs. It's a little footrest. They can put their foot on there to shave their legs, which is extremely thoughtful for Wealthy Wendy, our buyer persona. Then where we had the standalone tub, it's just an $800 tub, nothing crazy from Home Depot, but there's a niche out in the wall there as well. And it's like 15 inches high. And I'm like, honey, what's that for? And I knew what it was, but that's for her wine glass when she's taking her soak with the bath bombs and everything. So that type of foresight creates the most important thing, marketability, right? I think people that make investments, and I did the same stuff at a different level in long term, but I've applied it in the short term, is every decision we're making ties to two places. One, the hospitality and what our buyer desires when they are staying at the property, but two, does it create marketability for us? So there's a tremendous amount of intention with every step we take, identifying the property, determining how we're going to market before we even make it an offer. If I don't know what my Facebook ad is going to look like or what my cover image on Airbnb is going to look like, if I can't visualize that in the first 90 seconds of walking in the property and around the property, I immediately scratch it off the list. If I can't see it on a Zillow listing, I'm not interested. So I'm always thinking about how I'm going to market that property to that ideal buyer even before I'm even considering making an offer.
You're really emphasizing the concept that you make the money on the buy, that old adage when it comes to real estate investing.
1,000%. I don't even know how to unpack that because it's just so critical. All the money is made on the front end. I think anybody that's had success or failure in real estate investing, if they go back and they analyze the mistakes and the successes, they would say the exact same thing.
Well, let's unpack a couple of your successes and misses. Like, let's start with that. Like, what was one of the biggest lessons you've learned so
The
far?
biggest lesson was in property number 2. So I bought the first property in Fort Morgan, Alabama, suburb of Gulf Shores. And my wife and I knew nothing. And we thought after about 6 months after we took the property over from the property manager, we thought we knew more than we really did. So we were at the Winter Classic. I think it was 2020. I'm a National Hockey guy, right? Nashville Predators playing the Dallas Stars in the Cotton Bowl. About 3 Mondo, 20-ounce beers in, and I think it's between the first and second period. And my agent, who was looking for properties, like 24-year-old greenhorn guy, knew nothing. I shouldn't have been using him. That's mistake number 1. He does a FaceTime walkthrough of this small little 2-bedroom property about 2 miles down from my house. Number 1 mistake, it's on the bay side. It wasn't on the ocean side. Number 2 mistake, I said, yeah, draft me up an offer. Probably have another beer between the first and second period. So between the second, third period, I literally signed the DocuSign. It was like small deal, like $200,000 acquisition. So I bought it sight unseen from an agent that had cold called me, that was young and aggressive, but no experience, didn't have an inspection. It was an all cash offer. I just made every freaking mistake you could ever imagine. But then I repeated a mistake that I've done multiple times in my life, Jack. I had a handyman contractor guy that was struggling in his own life, and I have a weak spot for trying to help people. And you can kind of see where this is going to go already, most likely.
Blake.
Yeah. COVID hits. For some reason, hey, David, what's going on down there? And, the ring cameras aren't working. Oh, the city was by and they cut the utilities or whatever. And, some BS. And so I couldn't really see what was going on, down there. And then, 6 weeks later, I finally get down to Gulf Shores and nothing had been done. And I'm sending him, $5,000 checks, $5,500 checks, $7,000 checks every week. Long story short, I just made every single mistake that any newbie that doesn't know what they're doing can make. I ended up losing $127,000 on that deal. The house got hit by Sally, got demolished. I sold it at lot value. It was just a catastrophe. And that's what set me and my wife back almost a year and a half to 2 years to have to recoup that loss through the other investments in our primary income that we had at that time. That's when I started really documenting all of my systems based on the mistakes that I made, because I knew better. I'd been doing real estate for 20 plus years at that time. And I just thought that because of that first success that I'd be able to replicate it super easy into number 2. And it was a much smaller deal. And I just honestly was lazy and just wasn't thinking for whatever reason. That's my biggest mistake. It's the only mistake I've made in the short-term rental space. And I believe because of that mistake, it saved me hundreds of thousands of dollars. Thank God it was number 2 and it wasn't number 21. The biggest one was actually convincing my wife to sell that very first property. Shortly after that disaster, it was actually December of 2020, we sold that property, which was our lifestyle asset. And it was unique and it was amazing. And she thought we'd never be able to replace it. But I'll never forget, Deb Wood was my agent down there. And she's like, a bird in hand, and there's always something better out there. And so we took the cash out of that. We bought a lot, moved into the more prime area in Gulf Shores. I found an amazing builder, built a 2,900 square foot, 6'4", tier 2 on the beach for $600,000. I'm into the whole thing for $900. I think today I owe like $470 on it. It's worth $2 million, and it's done $300,000 a year since. It's been my number 1 property in my portfolio until I went into the Outer Banks about a year and a half ago. That would be the next biggest one, was deciding to take huge risks and buy older beachfront properties in the Outer Banks in the super prime location. If anybody's familiar, Duck is the epicenter of the Outer Banks. And we bought a 6.6 beachfront with a pool that took almost $600,000 in renovation from siding and windows and decks and all that type of stuff. Then we bought a second one on the north side of Duck and the very south side of Corolla. And we paid about 1.6 for one of them and like 1.9 for the other, put about 400 in the other one. And this was with a partner. Those two properties now combined this year will do about 1.1 million in revenue and spit off over 400, maybe closer to $500,000 in net income. Those are the catalysts of one of the reasons why I started getting into bigger properties as opposed to just staying in the 3, 4, 5 bedrooms. The next big one after that was there's a lake south of Nashville by Birmingham called Smith Lake. I had a 5-bedroom there for quite a few years. I still have it. But we bought a 7.6 and turned it into a 12.9, finishing out this basement, built 2 massive bunk rooms, like where we did built-in queen size beds, and it sleeps 38 with no bunks. 38 with no bunks. We paid 1.4 million for it, put in about 470, things worth about 235 now, but it yielded about $460,000 in rental income in its first year. So a lot of people navigate in the short-term rental space to like the 3, 4, 5 bedroom and kind of stay in the middle, right? They navigate to those middle markets that everybody's going to. I promise you 99.9% of your listeners have never heard of Smith Lake. If they say name one lake in Alabama, it's going to be Lake Martin, the biggest lake. So I'm going to the secondary and tertiary markets because I can enter, once again, that first part of the deal, I can enter at 20, 30% less than going to the primary market, but I can generate similar to even higher revenues out of those secondary markets as well. I am also focusing on the extreme small side, the 1 and 2 bedrooms, or the extreme large side. I try to stay out of the 4, 5, 6 bedroom areas because that's where everybody flocks to. I'm the guy that wants to carve my own path. Well, I'm skating away from Wayne Gretzky because everybody's going to follow him to that puck. So if he's going, to the front left side of the goal, I'm going to the front right because I know all the defenders are going to go there and he's going to be able to pass me the puck to score, right? So that's really kind of my strategy, Cliff Notes version, and it's worked very well with 99% efficacy without that one mistake that I made in property number 2. And I've done 77 short-term rentals, single-family home short-term rentals since 2015.
Well, I just have to point out the fact that it's one of those hard lessons learned, or you either get a coach like yourself, Bill, and have somebody show you how to do this and learn from Bill's mistake, or you're going to experience it yourself eventually.
I have a friend, a former client. He's America's coach. His name's Coach Michael Burt. He was the winningest basketball coach of all time in girls high school basketball in the state of Tennessee. And he has a saying that everybody needs a coach. And I can tell you from the time that I was 13 years old as a successful athlete, I ended up graduating from high school as the 3rd ranked golfer in the world. And if I didn't have a coach to be able to teach me, I wouldn't have been a top 100 golfer. As a real estate investor, if I wouldn't have had people teaching me how to do real estate or my drop shipping business in the 90s or a partner to coach me through my restaurant ventures, any of those things, you wouldn't be successful. And I don't care if you buy anything from me for the listeners and the YouTube watchers that are out there, but I will tell you, if you want to scale quickly, if you want to learn a skill set, you need somebody that has already achieved what you're trying to achieve to help guide you there on a faster path. We've already made the mistakes that you want to avoid. Jack, I bet I've spent close to $2 million in the last 15 years on my own personal education to get access to the rooms, to be in masterminds, to do that type of stuff. And without making those investments, and I was the anti-course, the anti-coach guy for many years in the professional world, even though I'd had success as a student and as an athlete, and then I became a successful college golf coach. Once I unlocked that and started investing into myself is when I saw my career path as an entrepreneur just skyrocket.
Yeah, I'm with you on a lot of that. In fact, if you would have talked to me 10 years ago about mindset and doing affirmations and a few other things, I would have called you crazy. I was just a strong believer in a lot of that this day. And wouldn't you say that the money that you have spent, it sounds like some of the numbers you're throwing out sound too good to be true in a lot of ways, to be blunt. But in the end, I would imagine that the training, that investment has paid more dividends than any of the others.
I had a very profound, life-changing experience with a gentleman named John Baird, and I've talked about him publicly. I have the largest short-term rental conference in our industry. I was fortunate enough, not last year, the year before we really went big. We had 1,000 people at my second conference. Last year we had 3,000. I got to cry in front of 1,000 people because he came and he sat in the front, put him in the front row, and I taught my life plan, which I learned from him. And he was a two-time Fortune 500 CEO. He's an angel investor. He's probably maybe in his 70s now. He fundamentally changed my life, and he taught me about these things, right? I worked with a sports psychologist when I was playing professional golf named Dr. Bob Rotella. He wrote a book, Golf is Not the Game of Perfect. And it's really all about our visualization and our self-talk. And what I found is I was really good at positive visualization. I would visualize where I learned this, where I wanted the ball to go, where most people are saying, don't hit it in the water, don't hit it in the bunker, don't drive into that tree when you're driving down the road, right? And I'm focusing linearly. Learned a lot of that from Earl Woods, Tiger Woods' dad, who I grew up with playing as well. But I never applied in business until John sat me down and taught me how to re-architect my entire life. Professionally, personally, relationship with God, relationship with my wife, and to be very intentional because I had business plans we talked about earlier, cash flow reports, balance sheets, all the stuff that goes along with being a successful entrepreneur. But you know what? I didn't have a business plan for life. And once I knew what I wanted to achieve at the end game, you talk about having the end in mind, then you can reverse engineer to make solid decisions every day of every minute moving forward. It took me 4 months to learn how to build out a life plan. And then we brought our spouses in. So I was in an organization called EO, and an entrepreneurs organization. And we hired John to manage 6 of us. And I'll never forget that first meeting, Jack. He walked in and he's an older, gruff, stern guy. And we have our binders and all our financials and everything ready to go. And he's like, put that shit away. And he throws down the life plan. He's like, you guys think you want to be like me, but you don't. Sure, I've been successful in business. I've done this and that and whatever. But I haven't spoken to my oldest son, who's now the president of a bank, for 8 years. I've been married 3 times. All the things that fail in the personal side because of the success, work-life balance is bullshit. You have to be 1,000% aligned with your spouse, and you have to mold both of those together. And that was a changing experience for me because for me, I was chasing money. I was building businesses. I was exiting. I was selling. So I got right with my wife. I got right with my kids. I had a 5-year-old. We had never been on a vacation. I'm working 7 days a week building 4 businesses. My wife and I have been married for 27 years. Unbelievable relationship. No cheating. I've never had to go sleep on a couch. Never went to bed mad. Any of that type of stuff. But it wasn't perfect. And there's no such thing as perfect. Once we united with that and we had unified goals of what we wanted to achieve in our sex life and our children's life and our spiritual life and our business life, it made it so much easier. It was like the weight of the world came off my shoulders. And we have probably 40x'd our net worth since that first meeting with John in 2015. At that time, I wanted to make $500,000 a year because prior to that, when Nashville got flooded and I lost my glow golf business, and after the recession, I was making like $660, the most I'd ever made in a year. Well, I can tell you now that I'm doing more than 10 times that goal that I wanted to do. And I work 20% of what I used to. And it's because of clarity. It's because of planning. It's because of those affirmations that you talk about. I mean, I developed this thing. This isn't for sale, but I took all the things from John and Brendan Burchard and Grant Cardone and Russell Brunson and these people that I learned from and I look up to and that I paid to get access to. And I built my own planner. That's personal, that's business, that's everything. And that all distills down into every business. I still have 7 businesses today. Outside of just, the real estate investing and the coaching, I have other things. And people say, well, how can you do that? Because I structure my life down to every 5-minute increment. From the time I wake up till the time I go to bed, and I learned how to say no. And if there's not intention to better either my relationship with God, my relationship with my wife, or to benefit my kids, I say no to it.
Well, Bill, I'm going to just let that mic drop right there. That was one of the best transitions I've had in quite some time, and I can't echo anything more than that. So, Bill, this has just been a fantastic conversation. I really appreciate you being here with me today. Again, I wanted to send everybody to billfaeth.com, billfaeth.com. That's going to be a clickable link in the show notes. Before we transition into the rapid fire and close out this episode, is there anything else we should have hit on?
No, I mean, I think hopefully I didn't ramble on too much and, got you. You've been a tremendous host. I'm just, grateful to be on your show.
No, like I said, if anybody gets anything, that last segment was well worth the investment of this episode. Well, if you're ready, Bill, we'll jump into the rapid fire and close out
Sure.
the episode.
Absolutely.
What lie do real estate investors often tell themselves?
That the deal is too good. So it's funny that you bring that up because I have a mastermind, and in our mastermind, we don't allow stories when somebody's buying a property. So show us, we have two things. I have a thing called a super property grader, and I have a pro forma. Show me the listing, the super property grader, and the pro forma, and no stories. Don't tell anybody. Most importantly, don't tell yourself a story because you start convincing yourself and you lie to yourself about how great the investment is. Let the numbers do the talking.
If you could go back in time and give your younger self a piece of advice, what would it be?
Take better care of my health. I didn't start taking care of my health until I was diagnosed 3 weeks prior to my 50th birthday as pre-diabetic, and I was 311 pounds. I've been down to around 235, and every biomarker I test every quarter now. Gary Brecka, if anybody is follow Gary Brecka, take his gene mutation test. I took his death test. I was going to die at the age of 61. I've pushed that to now 82. I have added on to my life based on the last 2.5 years of taking care of myself. I wish I would have started much earlier.
Do you have a book recommendation?
I am reading Cody Sanchez's book. What is it? Main Street Millionaire. Because that is kind of the story of my life of building a lot of small businesses. I've done some bigger ones, but I also have her as my keynote speaker at my upcoming SDR Wealth Conference. I am a big Cody Sanchez fan about speed, about diligence in making decisions, and most importantly, I think that one of the next best things to short-term rentals is acquiring some service businesses from baby boomers right now.
And finally, what single strategy or tool have you implemented that has had the biggest time-saving impact to you or your business?
Time-saving impact for me and my business actually was when I developed this, and probably most importantly, I learned this from a friend of mine. His name's Gary Vaynerchuk. He actually does 2-minute meetings. And that's one of the reasons that I started moving my schedule to 5-minute increments, because really the number one thing that does, Jack, it eliminates a lot of people. A lot of people just want to say, hey, can I get 15 minutes or 30 minutes? No, you can't. You want a 2-minute meeting? You want a 5-minute meeting? Well, I can't get anything done. Well, then you're not my tribe, right? So that's probably been the biggest thing from a time-saving standpoint.
Well, again, it is billfaeth.com. I really appreciate your time, Bill. This is just fantastic. And I hope you'll consider coming back again sometime.
Tomorrow?
Sure.
I'll come back anytime. You've been amazing. I loved chatting about life, real estate, and I appreciate you having me on the show.